Inflation cooling in the month of November just a bit, but consumers clearly feeling higher prices in a number of areas still. Grocery prices up 12% from a year ago. Airfare still up about 36%. Transportation services up about 14% on a year-over-year basis. Here to discuss all this impact that it's having on consumer spending, we want to bring in Brendan Coughlin, a Citizens Financial Head of Consumer Banking. Brendan, it's great to see you here. So the impact, or what we're seeing, I guess, playing out in the credit card trends that I know you're closely tracking. What does this mean for credit card balances, the impact that inflation's having on so many Americans?
Yeah, what's really interesting is that consumer confidence is really plummeting, but the health of the consumer is incredibly strong. So what we're seeing in the data is that spending year over year is up 18% in credit card. That's up over 40% from pre-COVID, so well above inflation levels. And it's really driven by a couple of things. So travel this year is up 40%. And all non-travel is up 14%. So we're seeing the consumer really not back up in their behavior, what they're telling us in their sentiment, that they're not feeling great about the economy, but they're out spending still, and we see that continuing.
Yeah, what do you make of that dichotomy? Why is the consumer spending so fast? Is this sustainable?
Yeah, well, look, all the stimulus that came out during the early days of COVID really drove a couple of things. So the average consumer right now has 20% more in deposits than they did before COVID, and they have less debt leverage. So their credit card balances, while you're starting to see them tick up a little bit, they're still well below where they were pre-COVID. So that's the health of the consumer is really strong. They have more liquidity, less debt. That's giving them the confidence to go out and spend the money, even though they're not feeling great about the economic situation. And mortgage rates are high and inflation is high, but their wallet is still fat.
Yeah, when you take a look at the New York Fed data, at least for the third quarter, credit card balances alone during that quarter were up 15%. That was the quickest growth that we've seen in just about 20 years. I think everyone wants to know, when the Fed continuously is raising hikes, we're expecting another rate hike tomorrow. What does that mean for credit card rates, and why should so many of our viewers care about it?
Yeah, look, when short-term rates go up, credit card rates tend to go up as well. Many customers have found comfort in buy now, pay later as a cheaper alternative in some spots. But some of the headline rates around credit card balance growth is a little misleading because customers delevered a lot during COVID. And so they're coming off of really all-time lows and building back up a little bit. So when you look at credit card debt overall versus where they were pre-COVID, it's still below that. So the health of consumers are pretty good. Now, the tail of the economy is felt differently across customers. So if I were to decile out the economy, the bottom two, so the bottom 20% of the U.S. is feeling the pinch a little bit more, and they're back to paycheck. But the majority of Americans still have more money, less debt than they did before COVID.
Credit card APRs are their highest rate in 30 years, and Congressman Ro Khanna, he wants to do something about that. This is what he tweeted. Interest rates on credit cards are so astronomical that someone with a $5,000 credit balance could pay an extra $1,000 in interest in just a year. He says this should be illegal. It's time for Congress to end Wall Street's predatory rates with the 15% cap. What do you make of that?
Yeah, well, look, I mean, credit rates are up, deposit rates are up too. The country has not been in a period of rising rates like this in quite some time. So the average U.S. American needs to adjust to that, and they are. Look, mortgage rates are at 7%. Home prices are starting to tick down. Deposit rates are up a lot so far, particularly the second half of the year. So I think this is just a recalibration. This economy has been in a state of persistent low rates since the financial crisis in 2008. Look, we're still in relatively very low rate range. If you took a 40, 50-year view, even despite the tick up in rates, they're still significantly lower than they have been historically.
It's amazing to me how much consumers continue to spend, despite the fact that it seems like we are hearing time and time again that we're heading for a recession.
It's the big GIF.
Consumers
I don't
are
get
resilient. I know. I don't get it either.
I don't get it.
Brendan Coughlin, great to have you. Thanks so much
for having me on.
Us.